Ivan, this is Rohit from Lifestyle Mastery, and I'm excited to have Chad Fox, who's the managing partner at Fox Ventures, which is an early-stage fintech-focused rolling fund. Fox Ventures invests in early-stage fintech companies around the world alongside Tier 1 VCs, sovereign wealth funds, and other notable fintech-focused investors. Fox also sits on the advisory board of several venture-backed high-growth startup investment funds, private investment groups, and family offices. He's a lawyer by profession and holds a practicing certificate from the High Court of New Zealand. Welcome to the show, Jan.
Thank you for having me.
Awesome. You have a very interesting journey because before we were chatting that you're Canadian, but you moved to New Zealand and you did your law over there, but you also worked in Middle East and you invest into US startups as well. Now, how did that move happen when you got your law degree from New Zealand and you got into the crazy world of venture capital?
So I first took a business kind of degree in Canada, and after that I didn't know what I really wanted to do, but I knew that I had to take kind of a further studies, and the decision was always between an MBA or go and do a law degree. And my friends at the time that had MBAs didn't have jobs that I was jealous about, and so I said I might as well go get a law degree and see where that takes me. And I wanted to get it done as quickly as possible, and so I looked around the world and figured out that moving to New Zealand for a couple of years and getting it done was the best way to do that. And so I went to New Zealand, got my law degree, and while I was there, I took quite a few classes in cyber law of the internet, corporate law around kind of financings and M&A and those types of transactions, and that kind of pushed me into the VC space directly out of law school. And so what drove me to the Middle East is when I was sitting in New Zealand, I basically decided that it was not a place that I wanted to stay long term, and I looked around the world again and said, okay, where's the place where I can go, be on the ground floor, be in an emerging market, but not give up, kind of the lifestyle that I wanted to have. So that meant, not going, hardcore into Asia or Africa or LATAM, and had a few friends in the Middle East and kind of went to Dubai and got set up and was one of the few lawyers there that understood early stage companies, and ended up in a few law firms that, where I was the guy that when any new business came in, I was the one handling it. And so I got to see a lot, got to learn a lot, and eventually figured out that I didn't love the business of law, but what I loved, so I didn't love charging companies for my 6-minute time intervals. And I ended up figuring out that I was spending a lot of my time fighting between the law firms and the company about fees. And so what I decided was, okay, what do I love? I loved advising and helping early stage founders get from, 0 to 1. And I looked at how is the best way for me to do that. And, I figured out that's actually what a VC does if they're good at their job, is that they're helping, their company go from the stage that they invest in, to the next, and so on and so forth. And so I made, I started angel investing, eventually left being a lawyer, and then I had to make the decision, do I want to go and join a bigger fund or go and do my own thing? And because I kind of had the deal flow and some, LP base, I decided to not join a bigger firm and started doing syndicate deals. And that basically leads me to where I am today, where we've invested in about 20 early stage fintech companies around the world, focused mostly on Middle East, North Africa, Pakistan, doing a lot in Egypt, Pakistan, a bit in Saudi Arabia and the UAE, obviously where I spent a lot of time, and the rest in the US. And so that kind of splits out for my investor base, half of which is Middle East focused, half of which is US focused. And so I kind of get the best of those worlds for the companies and for the investors that I get to work with.
Yeah, no, this is super interesting. And you talked about Middle East ecosystem. I've been part of the Indian startup ecosystem, which has really grown leaps and bounds in the last couple of years. But what is what is the differentiation for Middle East ecosystem, and have there been really big exits in the last couple of years for that ecosystem?
Yeah, so I think it's moving quickly. There's obviously a big shift over in that part of the world. We've seen Sequoia make its first investment in Egypt this year into a neobank called Telda. Kleiner Perkins went into Pakistan this year for the first time as well. So we're starting to see the bigger US funds take an interest in the region. I think we've also seen, obviously, there was a massive exit from Kareem that sold to Uber for $3 billion, and another really good one, InstaShop, sold for about $300 or $400 million. And so the ecosystem is growing. It's still really new. The thing that people don't understand is that it's very dislocated, but there's a lot of opportunity. Egypt has 100 million people. Pakistan is 225 million people. Saudi and UAE and the kind of entire region accounts for about $4 trillion of investable wealth. And so fintech products at the higher end, such as I've invested in a company called Baraka, which is effectively a commission-free trading platform that allows for access to US stocks. I mean, that side of the market is really good. I've invested in a crypto exchange and custody platform that's backed by 2 sovereign wealth funds called Midchains. And so these things at the higher end of the market are also doing extremely well. But it's a very fragmented market. The regulations aren't great, and they don't work together as between the entire region. And so you have to kind of understand the region as a whole and know how to operate there. And I think that, for me, I spent 7 years there kind of on the ground. And so I have a good understanding of what works there. And I also have 1 foot in the US as well. So I see all of the things that, are going on there, how they can be implemented in this, other market and what doesn't work. And, I think that gives me a good understanding of how to make those cross-border investments.
Right, correct. And when you look at investing into Middle East countries, how do you do the due diligence? Considering that those part of the countries, there's not been big exits as of now. How do you assess either the team or the market in those countries?
So, I mean, I've been there for 7 years, and I was advising a lot of early stage companies and investors, and there are obvious gaps in the market. So one of the theses I always had was go in as early as possible and look for secondary share sales, at that Series B level. So go in at the pre-seed round and exit at Series B. And, that was for a while a pretty good business model, because I knew that on a deal by deal basis, I'd be able to, easily make 10, 20x. I think if you look at recently, there's been a couple of companies that are going public via SPAC. And so that's a new phenomenon for the region. Angami, Swivel have both, signed their SPAC deals. And I think that's super interesting for that region as well. I think too, if you look at how some of those founders are building from there, but can execute in the US, that's something that I'm really working quite hard on, is where, you're built from the Middle East, but can execute in any other market around the world. I think that's something, extremely interesting. But because I've spent time there, I have probably a much, higher threshold for a company that'll invest in, right? It's not, whereas, in plenty of markets, you can invest in the 3rd or 4th best company, and it may still end up as a unicorn. Right now in that emerging market, it's kind of a winner take all model. And so I only back the companies there that I think are going to be winner or nothing. If I don't get in the winner, I don't back anybody else in the marketplace.
Got it. Interesting. And when you look at the current financial ecosystem, do you believe we are in the phase of bundling or unbundling for financial?
Well, I think we're still in the unbundling phase, but it's all fintech and all financial services is unbundling and rebundling. And so I think we're still in the unbundling phase, but I think what you're seeing a lot more is rebundling is starting, especially with embedded services, right? So anybody who has a strong network effect or has a strong customer base or has a strong voice can now rebundle all those products together and take the customer through their entire journey. And so they may not be building the entire product, they may be embedding another service, but I think they're still taking the unbundled pieces and putting them back into place. So I still think we're extremely early in fintech and financial services when it comes to a technology perspective. I think it's even though it's kind of the flavor of the week right now, I think if you ask anybody that's investing in the space, it's still literally the first 15 minutes of day one. And if you look at it on a longer term scope.
All right. And, I had Jake Gibson, who's the founder of NerdWallet and a partner at Better Ventures, who said that, every company could become a fintech company, but because of, COVID and because of, it had been an inflection point for payments company, do you think a lot of companies can become a payments company or they're becoming a fintech company going forward?
So my view is that you want to own the entire customer journey, right? The second that you lose your customer to another product, you're losing an opportunity within that space. So I do believe that every company can offer different services, and that's what we've seen with Uber, or in the Middle East with Careem, where they have Careem Pay, where it's very similar to, they're operating a Venmo type wallet where you can do peer-to-peer transfers and things like that. So I do think it's there. I think the biggest thing that I see is users hate onboarding at new places, especially in financial services, right? They hate doing KYC. They hate doing, the onboarding is much more onerous when you are in financial services. And so I think if you can own the journey from, an early point and be able to offer different services, you're going to do well. And I think also a second piece that's probably the most important in this is certain platforms know their customer better than anybody in the world, right? So, Walmart is a good example of someone who's getting into the fintech space that knows their customer better than anybody else around the world. And so they are in a good position to offer financial services to that customer. And so, yes, I think any company that has a strong customer base can be a fintech, they can be an insurtech, they can be, a med tech, right? They can offer these services, and open banking, APIs, the connectivity is there. So, they should, own that journey as much as possible. And that's also why we see, consumer fintech is probably the hardest place to be successful. But when you are successful, it's either all or nothing, right? And so, but if you already have that customer base, it's pretty easy to, to start a card service, or to start to offer your customers buy now, pay later, or to offer them some other credit product, or offer them insurance on whatever they just bought from you. I think it's whoever owns that customer relationship can offer them, additional services outside their core business.
And why do you think there's such a shift when it comes to companies becoming more of a fintech space? And do you think there's going to be a consolidation in this space going forward?
I think I think for the last 5 or 6 years, there's been a lot of companies building the tools that make this possible, right? So your B2B enterprise fintech players that, make embedded finance or, all these alternative products available for anybody is what we're seeing today, right? So, for a Facebook to be able to go in and embed a wallet into their service, someone else had to build that first to make even the thought process, available. You can see anybody can launch a card now through, the numerous providers that are out there. And so that I find super interesting. I think when you look at consolidation, yes, I think it's inevitable that there's going to be consolidation across the entire spectrum. Australia has 26 buy now, pay later companies in a really small market. Is that necessary? No, it's ridiculous. And so I think you're definitely going to see consolidation, whether it's at the lower mid-market or, as big players come together. I think it's bound to happen in the next few years, and I think it's going to be really interesting.
And if you remove the barriers to entry for more products, will it change the product quality and cost? Companies could combine a lot of different products, but if you reduce the entry for more products, do you think it will impact the quality?
So I think quality, for me at least, quality is still the most important thing. And I also think for bigger brands, it's kind of the best, and it's the fastest way to erode your brand value is by offering a inferior product out into the market, right? And so my view is that the companies that have a really strong brand are not going to risk that brand value to offer an inferior product. But because so many of those, let's just say lending products or whatever are becoming a commodity, that they're going to be able to go into the market, find the best one and offer it to their customer base, right? They have the ability to go and do that. And if it's not there, they'll build it themselves. But I think I don't expect kind of anybody that's, doing a really good job from a brand perspective to really, accept a sub-quality product. And, we're seeing good products become commoditized. You're seeing that in the remittance space. You're seeing that, in the general neobank space. You're seeing that in the payment space even. You're going to see it in the lending space. You're starting to see it in buy now, pay later, where, these core things are, these core services are becoming commoditized, and it's how best you deal with your stakeholders that determines whether you are the strongest player or not.
And one of since the thesis is mainly into fintech companies, you have invested into Y Combinator companies, and one of the companies that I'm excited about is Level, which is a trading platform that allows fintech startups to convert their loan receivables into upfront capital. And there've been a lot of alternative lending companies. What is about Level, which excites you, and why is it so different from others?
So I'm excited about Level because it's been a problem within my portfolio and the companies that I was advising before I started investing for the last 7 years, right?
Okay.
So I've always liked working with alternative lenders for two reasons. One is they can become high margin businesses, and the other thing is if you help them raise debt capital, then you're de-risking the equity side, right? So I always knew that if I was going into and investing in a seed stage alternative lender, if I was able to help them raise $10 million in debt day one, then they would be de-risked. But we always came to the same problem, is that before those companies kind of found product market fit, they were always lending out of the equity, right? So before, let's say, late seed to Series A, these founders had to raise a lot of capital, take a lot of early dilution in order to finance the loan book that they came out of. And I always thought that this was the craziest thing in the world. And so over the last couple of years, we've seen venture debt providers come out and start to finance these companies, but they still go in at a much later stage once they kind of learn how that company can underwrite the credit risk. And so what Level's doing and why it's super exciting is because it can come in and help those day one companies finance their loan books early, because they look at the underlying risk kind of from an early stage. They understand the business. And the second thing is that obviously we know that getting access to that recurring revenue, which a loan has, recurring revenue, it is a good way of financing that business without over dilution. And where it kind of exceeds, say, an ARR type or MRR type revenue-based financing, is that the underlying loans actually have security, right? And so if a good example is if Level is financing another one of the companies that I've invested in called Marco that does trade finance, Marco takes security over the lending that they do. And so they can assign that security to Level in order to back that kind of revenue-based financing product that they're able to offer them. So it's very early for that business, but I'm extremely excited about it for a lot of reasons. One, I can bring them, 8 to 10 clients day one. Two, it's a problem that I've been, unable to solve for my portfolio for the last, 4 years of investing and 7, 8 years of advising. And so there's a real need in the market. And I think as a niche business in that space, I can easily see them, deploying in the billions of dollars pretty quickly. And so I think it's reasonable to assume that they will be able to take a trajectory, similar to the other revenue-based financing businesses by focusing on this specific niche, and then having the ability to go into other products should they wish to do so.
Correct. And a lot of companies, when they take on equity, there's a dilution in the round, but at the same time they have the benefit of the advice from their VCs. But when do you think is the right time for a company to either decide to either take debt or equity? If it is product market fit, would you advise a company to take on debt? It could be very expensive going forward.
It really depends on their business model, right? And so for me, I work with a lot of companies in the fintech sector, and so if it depends on whether debt is the right piece for their business model. So there's two specific areas within my portfolio that I advise companies to take on debt for. One is obviously if they are lending out that money, then it's a better use of capital is to go and take debt, right? Even if they're having to pay expensive rates for it, it's still better than the equity dilution that they have to go and take. The second piece that I find quite interesting is, a lot of early stage fintech businesses are highly regulated. And so they have to lock up a lot of capital for regulatory and compliance purposes, right? And so that is money that just sits in a bank account and can't be used. And so there are some lenders out there that will provide, a convertible note type instrument that they can finance their regulatory capital and have a repurchase provision in there to be able to, buy that note back at a later stage. And so these are two things that I always like companies taking on debt for. If they're just taking on debt to extend their runway and it's not backed by anything. It's just like they assume that they're going to be able to raise, the traditional venture debt model. I don't love it, but that's, I think, why the revenue-based financing is now available. That's why new earlier stage venture debt providers are coming in and helping companies finance their loan books, and you're finding more interesting private market investors willing to look at this as an asset class. And I think it's quite lucrative if you do it correctly.
Correct. And a lot of fintech brands are now targeting the millennials and the Gen Zs. What do you think is a fintech brand should do to build loyalty with this emerging millennial generation?
I think it's the same with any business, is that you kind of just have to listen to the customer, accept feedback, and move quickly, right? I think the biggest thing with Gen Zs and millennials to an extent is that they look for information and education through various different sources, right? So you'll see some Gen Zs will only take investment advice off of TikTok, which, for someone who's a little bit older is going to think is the craziest thing in the world. But I think what the Gen Z kind of generation has learned is that information is freely available anywhere in the world, and you kind of have to take what you can from it and apply it in your day-to-day. And so listening to that investor and knowing how to access them is probably the number one point. And then moving quickly, right? If you're taking 6 months to deploy a product, you're probably going to miss the customer base or what they're thinking. And so that's one thing that we always I always try and tell the companies that I'm working with is try and be shipping products, features all the time, get feedback, move quickly, be as transparent as possible with what you're doing, and iterate when you can. There's, for some reason, like, that's always been one of the real benefits of the US and Silicon Valley, but especially in emerging markets, a lot of people don't want to launch or be doing anything until it's 100% perfect in their eyes, but they've never even spoken to their specific customer base. And so validate your idea, validate new features, and just ship product as quickly as possible, and then iterate it once you have feedback. I think those are things that people should be doing all the time, and have always been things that people have been advising on. But I think it's more important now because if you lose that brand value early, you're probably never getting it back, because there's so many other places that the customer can go.
Absolutely. And, for a particular syndicate, are there any major customer segments that you focus on, especially when it comes to fintech companies? And, what do you look for a fintech company when you're trying to invest into them?
So in terms of sector focus within the fintech space, which is getting so wide, I think I've focused kind of on a couple of different verticals. One is capital markets, both public and private, and how investors are accessing, both public and private markets and tools around that. Obviously, alternative lending is something that I've spent a lot of time in, buy now, pay later, education finance, trade finance, how, new forms of credit underwriting are there. The third one is obviously just pure play infrastructure, building tools to connect investors to financial products, embedded finances in that. And looking more and more lately at how data and alternative data can affect investment decision making, and how that all ties together. And I guess one of the things that I really look at is if those companies within my portfolio can work together, right? So Level's a perfect example, where I know that within my own portfolio there's a few companies that they can work with. And I think that's something that I try and do at least quite often, is make sure that if I'm investing in a company, I have the ability to make a few client introductions, or capital introductions very quickly that have a good, reasonable chance of success. And so that's kind of what I look for in terms of like the general scope of what I invest in out of the fund. Usually I look for seed stage companies where they're raising their first round of institutional capital. I can be convinced by a really good founding team to go in earlier. So, recently was convinced by the founding team at Baraka to go in at their pre-seed. Another one called KistPay, which is buy now, pay later in Pakistan. They convinced me earlier than their seed round to go in and get involved early. But usually at seed stage, I'm not a lead investor. I'm really strong advisor to the founders that I work with. And so I never set the terms. So one of the things I always look for is a strong lead investor to set those terms and to support even further. And then it always comes down to two things. It's team and market. And, market is probably the most important thing at the beginning, because if you're in a terrible market that has no chance to turn into a really good market, it doesn't matter how good the team is. But, a mediocre team can execute in a really, really good market. And I guess, obviously, I'm close with the founders. And so the founders are something that I have to really, really believe in over everything else, because, the market can change, right? We saw COVID change everything for a lot of people, but you can, so team and market is the most important things. And then obviously trying to fit in within the sectors that I work in. And then I like to kind of stay in the geographies that I know best, right? So US and Middle East, right? 7 years in a market, I know things on the ground that are, going to be not easy for other people to see. And also, I think you see a lot of people going into, LATAM super hot at the moment. You see Africa is getting really hot in the fintech sector, but a lot of people have never even that are investing in those spaces have never even been. And so I think you have a lack of, I always say that if you're investing in something, you kind of have to have access to information that other people don't necessarily see or have. And so I have that in the markets that I operate in. And if I don't have that in a market, then someone really, really close to me that I trust has to have it, or I won't invest, right? So if I don't, I think if you look in Africa is a perfect example, you've got the same 5 or 10 people that are doing the really early stage fintech stuff. They have access to that really early information. And if they're not willing to share that with me, then I'm not going to invest in that deal. But if they share it with me at the same time of their entry into that company, then yeah, I think it's a great opportunity. But I think you're seeing a lot of people throw money at jurisdictions or sectors that they don't understand or don't have, an information advantage on, which I think is something that, is going to come back around to, be a substandard return in their portfolio.
Right. Got it. And you run a syndicate, but you also run a fintech-focused rolling fund. I think AngelList has been quite disruptive, especially when it comes to angel investing and VC investing. Why did you start a rolling fund rather than create your own fund? And what is the investment thesis for the rolling fund that you run?
So I started on AngelList with the syndicate, and then I moved into the rolling fund. I think the syndicate, from my experience, is best suited for kind of Series B and later investment opportunities, or kind of Series A and later, where the company is trying to raise a larger amount of money and you have time to close. There's 3 negative pieces to a syndicate deal that don't work well with the seed stage and are the number one reasons that I started the fund. The first one is my syndicate has 1,000 people in it, give or take. Okay. And if I want to close an investment, I have to share the company's entire information with those 1,000 people in order to raise the money. And so that is a wide dispersion of information, right? And most seed stage founders, if they want to be operating kind of in stealth, or they don't want competitors or bigger groups to see that, the syndicate isn't the best place for that. The other thing is I never know exactly how much money that I'm going to be able to invest in a specific deal. And I never like to over promise the founders and then underperform. So the way that I would always do it was, instead of saying, hi founder, I want to, invest 300 to 500,000 in your deal, and then only come to them with a 100K check that my LPs filled out, I would always start at 100,000 and go up from there. And I never knew exactly how much I was going to invest. And we just invested our largest amount ever that was announced this week in a company called OnRamp. And I started there with 100,000 allocation and ended up well over $1 million with just the interest that we had. So that's a negative thing when you're dealing with a syndicate, because I don't have certainty of closure. And the last thing is no matter how fast AngelList moves, which they're very good, or how fast I move, which I'm fast, or how fast the companies move, it still takes 2 weeks to close a syndicate deal, versus, with the rolling fund, I can, go in and write a check in a day if I really want to, right? Really fast, next day service. And AngelList has been amazing. And I think the one thing that, everybody, they have 25,000 or more already accredited investors. So you can go as a new syndicate or new fund and get access to that. I am one person. I cannot, speak to 25,000 people and have access to them for my fund. And I chose the rolling fund model for several reasons. Firstly, it's a good step from the syndicate to the fund model, because I get to raise money on a quarterly basis. So I don't have to go out and raise the entire fund amount day one. I get to raise on a quarterly basis. The other thing I get to do is my quarters close on the last day of the second month. So I can go out to my LP base and say, hey, these are the companies that I've invested in the first 2 months of this quarter. Do you want to join in this quarter? And they can opt in or say, no, thank you. And that provides them the same kind of thought as the syndicate. And then I have some institutional investors that were looking at me as a first-time fund manager. And one of the things they always said was, well, we want to see your track record. And the great thing about the rolling fund is, they can choose their commitment level, right? So if they want to say, Chad, we're going to test you out for 4 quarters, for 1 year, they can do that, right? They can invest for 4 quarters and see the track record, see how I'm operating, and then make a longer commitment. If they want to do 1 quarter, they can do that, which from a traditional fund is impossible, right? The way a traditional fund works is that you raise the entire amount of money up front, you invest it over, the next 18 months. By the time you get to that 12-month period, you start raising your next new fund, and you're doing that off of, very little information. And so a lot of institutional investors don't look at emerging managers because they don't know how to get into that subset of information. But where I've been successful, at least explaining it to my, institutional investors, and they would have never backed me if I did a traditional fund because I'm, a new manager, was like, hey, this allows you to come in and build a track record and build trust with me in real time. If you don't want to continue after a year, you don't have to. There's no commitment, and you get, economics and all the previous investments that you've done. And so for LPs, you pay for the flexibility, but it gives you the ability to, not have to take a 2 to 3 or 4 year bet with me. You can come in, you can say, okay, Chad, I'm going to test you out for a quarter. If we've never spoke before, you can say, I'm going to test you out for a quarter. You'll get to work with me for, the 3 months, see how I operate. And then you can say, okay, let's, new trial period is now a year. And that's something you can't do in the traditional model. And so that's exactly why I chose AngelList. And it's been, a good decision for me, even though, I'm a lawyer, I could have done it myself. I have access to every other fund management platform. I've invested in the best fund management platform in Europe, but the only difference with that one is I didn't have access to additional investor base, which you can't. It's hard to beat what AngelList has built there from the network effect perspective.
Correct. No, absolutely. I think AngelList has done a great job when it comes to angel investing and democratizing it. And you've invested in over 20 fintech deals, but is the plan to invest? How many investments do you plan to do through your syndicate and through your rolling fund in a year?
Okay, so the rolling fund is my primary investment vehicle now, and so the rolling fund will do all kind of pre-seed, seed, and Series A investments up to $250,000. Anything that's larger than that, then the syndicate will also come in and do. The syndicate will also do anything that's Series B and later, and so I expect to do probably about 4 to 5 deals a quarter with the rolling fund, right? So that ends up being about 15 to 20 deals a year. And then the syndicate will probably start to see about 10 deals a year. And that will start to scale a little bit more in the coming years as the companies from the rolling fund break out and start to become larger and get to kind of go and take on more capital. And so I expect for them to work very well together, but obviously the best deals are in the fund. And, so if someone was like, how do we work with you? My advice would be to at least invest in the rolling fund to see the entire deal flow. And then you can pick the later stage winners when we go and do SPVs through the syndicate. And so, there are some people that do it more as an indexing where they write small checks from their rolling fund and then also do syndicates on the side. That's, not what I'm doing. My primary investment vehicle is the rolling fund, and the syndicate will get those kind of off thesis, later stage, larger ticket opportunities that don't meet the mandate of the rolling fund.
Got it. And you're a single GP in your fund. Are there any insecurities as an investor? Since you got to compete for other deals, and you're a collaborative angel, but sometimes be a competitive fund manager.
So I don't find myself competitive to any other group that is out there, even whether they're a syndicate, or another rolling fund, because it's me, right? And so I have the back end that is AngelList that makes sure that everything's done in an extremely professional manner. Like it feels like there's 6 people, team behind me that are really taking care of everything that's there. So I have no worry from that side. Larger VCs don't find me competitive because I'm not setting terms, right? So they're setting the terms. I'm not, battling them for allocations or ownership percentages. And I haven't come across an early stage fintech company that says that having someone with a legal background that's been in the VC space their entire career isn't worth carving out a chunk of equity for, right? So I actually find it very, very easy to get into the deals that I want to get into, and I've set certain parameters around making sure that that's why I don't lead deals, right? Because I don't have the resources to go and do to make that happen in terms of doing a 1,000-page due diligence, right? So I rely on my network. I take introductions only from people that I've invested with or are investing with, or from founders that I trust. Like I said, I don't lead rounds, so I always look for a strong lead investor to set the terms. And so I'm pretty comfortable in my thesis. And like I said, I've never had a founder come to me and said, Chad, you're not a useful, excuse me, a useful participant on our cap table. And, actually a lot of the times, and I'm not, just saying this, you can speak to most of my founders, is that they will always have considered me as probably one of their more helpful investors on their cap table. And so I look at the VC space. You either come in one of two of the spaces. You're either providing support or you're providing money. And if you're not providing either of those two, or you're making it difficult, then you're not going to be on the cap table. And I used to remember this from when I was practicing law, is there were certain, investors that were really annoying for a $25,000 check, right? And just like, really bothering the founders all the time, a ton of needed their own lawyers to go check the documentation, even though they weren't leading the round, and just founders stopped working with them. And so I think for me, I love being a micro VC, a micro fund. And so I like writing small checks, being helpful. I like being, helpful to the bigger investors that, can go and write those $10-20 million checks later down the road. And so I think I fit really good into the ecosystem for both founders and for co-investors. And obviously that's a great spot for my investors to be in, because of the way that my fund's structured, they can write lower checks into my fund that they would never be able to get into some of the funds that I invest with. And so I think it's the way that I've designed it is perfect for both myself, for the founders that I, have the opportunity to work with, for the co-investors that bring me into their deals, and for my investors that get good access to really strong deals. They know that I'm going to be hands-on and helpful, and they wouldn't get access to those opportunities in any other way.
Got it. Yeah. Chad, I quickly want to do the top three. What's your favorite business book or any content piece or podcast that you listen to?
So I'm, I get probably every one of the, FinTech related newsletters that comes out. And so like, I'm always constantly reading those. I think, The Angel by, Jason Calacanis was one of the books that got me into kind of investing. And I think it's a good spot for anybody to start. I love a lot of the people that write or talk about kind of the intersection of, finance, technology, and, the economy. And so Anthony Pompliano is one that I always like to listen to. And those are always the buzzwords, but they're the people that are, are out there and have built what I want to build. And they've, those two guys have done it more from a media focused way. I'm probably a lot more behind the scenes than they are, but they've also built the kind of investing businesses that I look up to, and kind of led the way on, how to build a syndicate, how to build a rolling fund, how to build, be a micro GP, solo GP. And so anybody that's doing what I want to be doing, or where I want to see myself, or where I want to surpass and be better than, or, strive to be better than, and are people that I kind of look up to, and I'll consume their content, kind of religiously.
Got it. And we'll put that in the show notes. And, if you could go back in time when you started, investing into startups and starting your syndicate, what is the one thing you would have focused on or done anything differently?
I think I think the biggest thing people can learn is that it's time in market versus kind of the number of, like everybody says, okay, you have to build a portfolio, but I think what's one of the things that I've learned over the last few years is that time in market is very important. So like you're constantly learning. And so, if I invested in 50 companies my first year, I probably, wouldn't be doing this now, because I've learned so much since then that's kind of improved my investment thesis. I think the one thing that I would have done earlier was kind of evaluate how I was structuring the deals, just via AngelList, right? Because I started my syndicate not on AngelList, and then I had to move onto AngelList, and then I moved from a syndicate to a rolling fund. And what that's done is kind of had a level of disruption for my investors, that I'm constantly having to, teach them about the platforms, or, what is a rolling fund. And so I think if I look back now, when I first started, their AngelList, I think, was doing syndicates then, but they didn't have the rolling fund product. I think if I was starting again now, I would do everything in my power just to go into one product and have that business model kind of set in my mind from the beginning, because the time to educate the investor base on, why all of a sudden you're going from doing, a syndicate every couple of weeks to now doing a fund, it takes some education, and some of your investors will drop off. What is important is that I'm doing it because it gets us better deal flow, right? Better access to companies. And because my best companies asked us to do it, right? My best companies. And what I always tell people is my miss list, because I was a syndicate, was starting to look better than the companies that I had invested in, because the best founders understand, the downfalls of a syndicate and don't let me, weren't letting me invest. And so I had missed a couple companies that at, let's say, the seed stage, where they'd raised, at under 20 million valuation, sometimes around 10, 15, and now they're 200, 300 million dollar companies. And we missed all of that growth because the founders didn't like the syndicate. And so having the rolling fund is the best access for my investor base. And then they'll be able to double down on the winners through the syndicate later. So I think that would have been the one thing that, if I look back and said, what should have I done 4 years ago, would have been go straight to, one platform and live or die by that platform, and build up my base there. And then once you get to a certain mass, you can always then consider the platform that you're using. But I think for me, if I would have gone to AngelList 4 years ago and set up the syndicate, then started doing funds, really early, did the syndicate, the same business model, it would have saved me some headache, but it may or may not have made me more or less successful. But again, I'm the same thing as, I'm a startup as well, right? And so you kind of test things out, figure out, how they work with your customers. And I'm a two-sided marketplace, right? I've got two sets of customers. I have the founders that I serve, and I have the investors that allocate money through me into those companies. And so I have to listen to both of them and what they want. And so my founders were telling me to set up a fund. And so I said, okay, I'm doing that. And my investor base has supported me. But it did take a lot of education for the investor base to say, why are we, making this change? And so I guess I would have just done that from the beginning rather than, switching now.
I think, as you mentioned, it's important to reiterate and test new things. And I think AngelList has been so disruptive, and with the new product, I think it's worked out a lot of new fund managers. And do you have any favorite online tool, for example, Gmail, Slack, Zoom?
So I'm still like, obviously I use Zoom a lot. I use Google a lot. I'm still like pretty I think also as I've become busier, I use a lot of things like Calendly is a really, important one for me to keep my calendar straight. The other thing that I like a lot is DocSend, which is really good for me because I can put all the, private documents in there and send a link. And what it really allows me to do is it's an analytics tool that I get to see who's viewed the pitch decks of my fund or the companies that I'm investing in. So I know who to go and reach out for. I still use email mostly to communicate with most people just because it's, I've had to protect both, my time and availability. The more and more you kind of get active, the more people want all of your time. And so email and Calendly and, has allowed me to do that. But I think the last year, Zoom has been, or video conferencing in general, has been one of the most important things for me because now it allows me to really operate across, my jurisdictions without having to be on the ground all the time. And I think that's been the best tool for me.
We'll put that in the show notes. Chad, what is the best way people can reach out to you and know more about your syndicate and the rolling fund?
So best way people can reach out to me is probably initially through LinkedIn. I'm pretty easy to find on there. From there, the great thing about AngelList is you can go onto my rolling fund page and become an investor without us ever even having to have a conversation. But most investors will reach out to me through LinkedIn. I'll send them the link to the rolling fund. I'll send them a link to my calendar so that they can book any time to have a conversation. And then that's the great thing about AngelList, like I said, is that all the investments done directly on the platform. And so they get to literally, with one push of a button, become an investor in the rolling fund. And once they do that, then they get access to all the deal flow, whether it's, through the fund or through the syndicate. So go join the rolling fund and then, or reach out to me on LinkedIn for a chat around that. And then it's, pretty easy to access me once you're, an investor in my fund. I don't really have the ability to say no after that. So that's the easiest way.
We'll put all the links for their LinkedIn profile and your rolling fund link. Charles, thank you so much for taking our time and speaking to us. I really enjoyed my conversation with you.
Thanks for having me. Really appreciate it and looking forward to the next one.